Ladies and gentlemen, many of you have written to me asking me, Mr. Lu, why the Middle East situation is so bad, the oil market is so bad. How come the stock market keep going up and up and up and up? So today I'll explain to you why this is so, and more importantly, we will examine the key wisdom of two top financial analysts, and one of them is Professor Jeremy Siegel from Wharton University, and the other one is the infamous Tom Lee, who has been very sharp and accurate in predicting stock market. Let's watch on, shall we? So the market is near all-time high again, just 2% away, and we are in the middle of a war that doesn't seem to have an end, and oil prices is still going up, and the oil market is still being disrupted. The question is why? Well, today we are very fortunate. We have got the key inputs of two top Wall Street strategies, and they are explaining to you why. So as I bring you more and more breaking news and top analysis from the world of finance and the world of economics, please remember hit subscribe as I bring you all this very important news. So Tom Lee is one of the founders of Fundstrat. Tom Lee is infamous for making very good prediction. He is what we call a permanent bull. That means he's always predicting the stock market is going up. And I'm a big fan of Tom Lee, and I've quoted him many times. The other person we are analyzing his inputs is Jeremy Siegel. So Professor Jeremy Siegel teach in Wharton University and is one of the top university in the world for business and finance. And he also provides very good analysis, and he has been sharp on predicting the outcome of stock market as well. So today we're just fortunate that both of them came out and speak about the current situation, and let me give you what they say. So we're now in a very unusual situation where the Middle East is in chaos, the oil market is in shortage, and traditionally this would spell a terrible outcome, but yet the stock market is still going up higher and higher and higher. And this has caused a lot of confusion to why is that happening? Shouldn't war like this crash the stock market? Well, we shall see. So the core thesis is this. I'll give you a high-level summary. The key takeaway from two of them is that markets are now more accustomed to receiving bad news. They can withstand bad news better than they used to. And let's not forget that who is the biggest beneficiary of war? That's US market. So the defense spending in times of war is a powerful stimulus to the economy. And guess what? This time around is really high, and I'll tell you how high in a short while. And the current consumer in the year 2026 is not the consumer in 1973. And the belief of the consumer, especially those in US, is able to withstand the pressure of the elevated oil prices much better. And however, there are still a lot of risks, and both of them highlight that these risks should never be ignored. Now, first of all, Tom Lee highlighted this, which I think is a big insight, that war spending is a stimulative spending. So every month in times of war like this, the US government spend an additional $45 billion. They spend it into weapons, they send to soldiers, they spend to all sorts of things that support the war activity. And this is in a high of $45 billion. And it could reach even $60 billion. And the customer drag caused by the higher oil prices is only roughly about $12 billion. So here, the economy have a stimulus of $45 billion. Here, the oil prices cause a downward drag of $12 billion. The net is still highly positive. So this will cause the entire economy to still boom. So that's his argument why the war is always in the mid to long run very expansionary for economies. Now, the point number two by Tom Lee is the consumer of 2026 is a lot more resilient than that of 1970s. In 1970s, the income is a lot lower, and the proportion of fuel charges expenditure in the average household budget is very high. But in 2026, well, the oil prices did go up. It probably add another $50 to $100 more a month. And I think most of the US family can handle this blow. So this is not like the same oil shock of 1973. And will it cause a recession? Well, the answer is, if it does, not yet. So it might never lead to a recession if things stay where it is and don't worsen. So he don't think that at the current level of disruption is enough to cause the economy to go downhill. Tom Lee's third point is markets react very positively for wars. So, for example, in 1941, December, US enters World War II after Pearl Harbor is being attacked. The stock market have a very negative reaction. By the time it reached May 1942, even before the Midway battle where US scored the first victory, the stock market already bottomed. And by the time they won a powerful victory in the Battle of Midway, the stock market started rocketing. So as it goes on from 1942 all the way to 1945, the stock market goes up and up and up. So wars are very positive to economy and the stock market. Now, we also need to note that over the last 6 years, since 2020, 2021, 22, 23, 24, 25, 26, all these years, there were so many shocks to the economy and to the stock market. We've got a COVID crash. We've got a great inflation that caused the interest rate to go up significantly. We've got the Liberation Day crash. And now we have got this one. So all in all, within a 5-year period, we got many shocks. And markets are, well, I would say inundated. Maybe that's a wrong word. Markets are more resilient, be able to tahan, be able to withstand this hit. So they don't go into full-blown panic. That's why you don't see the market crashing significantly. So the market does go into a downdrift and then recovers. So the answer is the markets are very forward-looking and they see that these too shall pass. And it's very likely this whole crisis will pass in time to come if both Iran and US comes to some kind of agreement or a prolonged ceasefire and allow the oil trade to go on. Well, Tom Lee maintains his prediction for S&P 500, 7,700 points. Right now, it's about 6,800 over points. He believes at end of year, 7,700 points. And that's what he strongly believes in, despite all these things that are going on. Now, I recall, not today, that in the past he did mention that there is a likelihood that the market will retest a bottom along this year. Well, he didn't say it this time, but I would try to remember what he said, that it could potentially go to a 10, 15, or even 20% downdrift. So I will still hang on to what he says. Nevertheless, we don't need to predict, we just need to react, okay, of what could come. Now let's take a look at Professor Jeremy Siegel of Wharton University. Professor Jeremy Siegel is a legend in the world of economics. When I was studying economics in university, I used his textbook. So that's how famous he is. And Professor Jeremy Siegel is a regular opinion giver in the stock market. And like Tom Lee, he's very accurate in his prediction. So basically, this is what he says. Well, many of the investors and the entire Wall Street are now looking through the war. That means that, no, this war, yes, I see there's a war now, I'm looking beyond that. So we're looking at forward earnings, not current earnings. And as long as the oil prices hovers around $4.25 per gallon threshold, I think right now it's around there, okay? The defense spending stimulus will offset the consumer pain. This is exactly the same argument that Tom Lee gave, that defense spending spends so much money, all this consumer pain will be a lot less compared to the pain. So now he actually says that the naval blockade that's done by President Donald Trump on the blockade that's done by Iran is actually very good and could potentially de-escalate the whole thing. So he said that maybe they should have started by doing that rather than using airstrike. So this is something quite interesting that he sees is very positive. So he says that the market is telling you something rather than you think that the market is blur and dumb. Well, he did paint a two possibility outlook. Number one is that if Iran breaks the ceasefire, then it could be more oil facility being bombed. Then the oil prices could shoot up to $150 or so, and the markets will retest the March lows again. Well, if they could reach some kind of a formal deal and formal agreement, which the US and Iran are rumored to restart a second peace talk, then the markets could go to an all-time high again. So right now, they all came to the same agreement, both Professor Jeremy and Tom Lee. It's nothing to do with earnings. It's nothing to do with stock market graphs, painting, or whatever. It's just geopolitics that's driving the outcome. Both of them could not tell with precision what could happen in the short run. So, and they outright say that this is something that is of high risk. Now, clearly, the investment community and the world globally is pricing a very positive outcome. So what the market is implying by pushing the S&P 500 up is that is most likely going to have some kind of a handshake between the two parties. So this is something that the world is leaning to in the investment world. They believe that this crisis, in a short while, in time to come, before the oil market cause more harm to the economy, the ceasefire will eventually come to a permanent ceasefire. I don't know whether this will lead to a peace agreement, but at least it will stop fighting and allow the Straits of Hormuz to go through. Now, this is what the market believes in by pricing the S&P 500 higher and higher and higher. Well, will this really happen? It's really difficult to tell. Now, I'll just say this. We are being resilient right now doesn't mean that this equals to stability. So let's all be cognizant that all the swings could still happen and there are a lot of geopolitical outcomes. We can't tell. I can't predict the outcome in things like that. And I've learned that whenever Donald Trump is involved, things can change rapidly and quickly and unpredictably. The second reality is what I've already said in the video yesterday. While we cannot predict what could happen to the geopolitical situation, we can surely predict that inflation is coming, and in fact, it's already here. Yesterday, as we polled the community, everybody has already received some form of a higher price in their family budget. Usually, it's in food and groceries and transportation. So these three areas, we already begin to feel some kind of elevated price. Now, to be fair, right now, it is still manageable. And fortunately, Singapore and Malaysia, we still have enough fuel to last us for quite a long time. Now, we cannot escape inflation. And the fact that we have inflation here also means that US have inflation. And inflation is always bad for stock market if it persists. So if these do not get resolved quickly, inflation builds up, then I can tell you with certainty the outlook will look very bad for the markets. Now, let's hope that this thing won't last for a long time. Then the inflation will be a transitory one. So the downside risk is fundamentally unpredictable and unknowable. So if the markets, if the oil prices goes up to $150 a barrel, by Professor Jeremy Siegel own estimate, it could happen in days, not months. Then maybe the worst case scenario of a downside dive of 15 to 20 to 25% is possible. But if there's a handshake between Iran and US, I don't know whether Israel need to be involved in this, but if a handshake were to be arrived at, then we are looking at possibly an even 5-10% upswing overnight. But these are outcomes that are unpredictable. We can take a bet, but it's really difficult to guess. So what do we do? Well, I've repeated this again and again. As crash investors like myself, we don't need to predict. We just need to react. If it crash, we buy, right? So when it was around 10% down, I did take some positions and then it quickly rebounded. I hope you had crashed more, but it didn't. But it's okay because there's a huge portfolio that I'm still holding on around that will still go up if the market goes up. Now, if the market continue to ride up, fine. If it comes down, we take a position again. Meanwhile, what do we do? Well, there are always positions that you can put your cash into. For Singaporeans, I've repeated again and again, take advantage of your CPF. Your CPF earns 2.5% in ordinary account, 4 to 6% in your special account or your retirement account. Why do you want to give that up, right? So put the money into there, you compound powerfully at zero risk. Arguably even better than that of the stock market because it carries no risk. Now, for the Malaysians, my goodness, you have something even more powerful than the CPF. That's called an EPF that gives you 6% return. And I wonder why many Malaysians didn't see that. 6% return. And if I were you, I don't even need to crash buy in the stock market. I just put my money into a 6% and just let it ride. So I'll just say that, this is something that, we should take a position of patience. And as Warren Buffett always say, in the stock market, wealth is transferred from the impatient to the patient. So I advise everybody to be patient as we see what things unfold. So this is where I just want to wrap this up, that the outlook of Jeremy Siegel and Tom Lee is very optimistic with some caveat that things can suddenly flip. So if they cannot predict as top predictors of the world, then neither can we. And so therefore, let's not take a position that we need to predict. Okay? So thank you for watching, and I'll see you in a live stream tonight. Bye-bye.